Have you ever wondered what separates the consistently profitable trader from the losing trader? It's risk management. As a day trader, you're not responsible for placing orders or knowing what the market is going to do next. The only thing you are responsible for is managing your risk. So why does risk management matter? Trading success is not about making profits. It's about managing your risk. Even the greatest strategies are going to fail without proper risk controls. It doesn't matter if you have a strategy that is right 80% of the time. Without proper risk management, that 20% of the time that you are wrong is going to blow up of your account. So protecting your capital always has to come first, and the profits will follow that. So the golden rule of risk is to never risk more than 1 to 2% of your account per trade. This keeps you the gain even during losing streaks. And it happens. If you flip a coin 20 times, it's not going to be 50% heads and 50% tails. You might have a losing streak, where it's like tails 8 times in a row. It's not going to always work out, one or the other. You have to be ready for drawdowns, and risk management prepares you for that. So as an example, if you have a $10,000 account, never risk more than $100 to $200 per trade. Even if you're wrong 5 times in a row, you've only lost $500. You still have lots of capital to trade with. And this is true even when trading with a margin. So a lot of brokers will give you a 4-to-1 margin, so you have $40,000 in buying power. The risk is still based on your current equity, so it's still only $100 to $200. Make sure not to make that mistake. So how to understand this risk per trade? If you could only risk, 1 to 2%, you need to know how big your share size should be whenever you're taking a position. And this is actually quite easy to do. Your risk in dollars divided by the distance to your stop loss will give you your position size. So for an example, if you want to risk $100 and your stop loss is 50 cents away from your entry, you can purchase 200 shares. Now, this math can get a little complicated when you're in the heat of the moment trying to take trades fast. So what I do is I have a handy cheat sheet based on my risk that tells me how many shares I can buy based on where my stop is. So again, we're using an example of an account size with $10,000, and my fixed risk is 1% or $100 per trade. And so I know if my stop loss is 10 cents away, I could buy 1,000 shares. If it's 20 cents away, 500 shares, etc. So I always have this handy sheet printed out next to me, and I do it based off my current risk. So this is great for $100. You can create other ones for $200, $50, $10. It doesn't matter. Create your cheat sheet and have it next to you when you're taking your trades so that you can quickly calculate the number of shares you could purchase based on where your stop is. Which brings us to the next point of risk, your stop loss and where to put it. This is very important. There's only one place to put your stop. At technical level, they disproves your trade hypothesis. There is nowhere else you can put your stop. And I'm going to give you a few examples right now about how you do this. So here are 2 trades. The first is a 5-minute opening range breakout, and it's off a bull flag that is formed. So we have 3 candles moving up, and then we have a consolidation. I want to enter my trade at the break of this consolidation. My stop is going to be below that consolidation. So I'm saying this consolidation to its support. If the price goes below that, then my trade hypothesis is no longer valid and I get stopped out. So now I know exactly where my entry is. I know exactly where my stock is. I can see the price difference between my entry and my stop, and then I quickly calculate how many shares I can buy. In the next example, here's the view at bounce. So my trade hypothesis here is the price is returning up to the view at, and I want to see it reject the view at. If it does that, I'm going to enter at the break of the candle that rejected view at. My stock, I know it's going to be just above that technical level, which is view at. So I know where my stop is. Again, technical level, I know where my entry is. Once I know the distance between those two, I know how many shares I can buy. If the price goes back up above the view at, I get stopped out right away. And that's fine. this will happen, but I always have that stop there, and it's always at a technical level that disproves my trade. So that is our drawdown, or our risk per trade. Next, for risk management, is we have to look at our maximum daily drawdown. So this is the most you can lose in one day. And so this prevents revenge trading and emotional burnout. It prevents you from going off the rails. You know, if you are losing consistently, you start making bad decisions. So you need that maximum daily drawdown. So the common rule for the drawdown is no more than 3 to 5% of your account balance. So again, for a $10,000 account, you would stop after a $300 to $500 loss in a single day. All right, so once we have, you know, our risk per trade, our maximum daily drawdown, we can go through our risk control checklist before we start our trading day every day. We're gonna define what our risk per trade is. We're gonna make sure we use a stop loss on every position. We're gonna set our daily drawdown limit. We're gonna avoid over leveraging, so that is taking too many shares. We're gonna set our stop at that technical level, make sure we have our share sizing right. And then we're gonna track these trades, and we're gonna review our performance weekly to make sure we're adhering to our risk management, and that is properly tuned to our trading style. So the big thing about this is, you know, emotional discipline, and the big part about this is discipline. You know, trading actually is a very psychological activity. There's a lot of emotion involved. You're making money, you're losing money. So you have to be very disciplined. You have to make sure you never move your stocks hoping for a reversal. Your stop is at the technical level. You get stopped out, you get stopped out. You can always get back in if the trade goes back in your favor and you have a new setup and you have a new clear technical level for your stop. Accept those small losses. They are a part of trading. That's why your stop is there. Just accept it. Your wins are going to be bigger than your losses. Even if you have more losses, so you have to build that consistency and discipline. When you first start trading, this is very difficult. You always think, oh, just one more trade, even though I'm beyond my, you know, maximum daily drawdown. But you have to be disciplined in this, and this will come over time. Remember, trading is a marathon, it's not a sprint, and having risk management keeps you in that marathon longer. It preserves your capital so you can keep trading another day. So here's an example of a risk management plan. And I have this at the start of my playbook, and I will adjust it as I, you know, manage my risk and I have more equity in my account. I will come up with new rules every few months. But first I look at what's my max risk per trade. And for me right now, it's 1%, but actually usually I have it around 0.5%. What's my maximum daily drawdown? No more than 3%. To be honest, right now it's actually at 1.5%. And then the last one is what's my maximum weekly loss? And for me, this is actually rang out 5%. And this is to, you know, control yourself. And if you're not reading the market well and you lose 5% of your equity in a week, you should stop trading that week and just go back, trade in with simulator for a week or two, work out your problems, and then come back to trading live. So you want that weekly loss as well there to help protect you psychologically. So you have a key takeaways. Control your losses means protecting your capital, and that means long-term survival. You know, it doesn't matter if you lose $300 a day on your $10,000 account. It matters if you lose $3,000 in one day on a $10,000 account. Keep the losses small, because those small controlled losses are natural. Every trader has to. If you look at any professional trader's trade log, you can see a ton of small losses and a few big wins. That is how professional traders make money. Risk management turns these random outcomes into predictable success. You can start measuring, hey, I don't only right over 30% of the time, but you know that 30% of the time where I'm right makes way more money than I lose that 70% of the time because I'm throwing that risk. You know, I'm only losing $100 a trade, but I'm making $400 when I'm right. So I'm actually making about $300 overall each trade in average. So if this helped you, hit subscribe and join me on the journey into consistently profitable ace trading.